Welcome everybody to this week's edition of Reverse Mortgage Weekly, where we go over all of the reverse mortgage questions that you might have and go over the program. And really, the idea of doing the Reverse Mortgage Weekly is to ensure that people have good information and can make informed decisions about this program. I do this every day, all day. I have for several years. I've been in the industry for 21 years. And I've never seen a program that has provided so much benefit and has had so much misinformation out about it. A lot of people look at this program as a program of last resort, but it really is not. In my opinion, this is the greatest financial planning tool that most people have when it comes to retirement. And I was talking to one of my clients about that today. The second I'm eligible for a reverse mortgage, I'm going to run down to the bank to get one just because I see the benefits of being able to not only eliminate your housing payment and not eliminate it, but convert it into a payment optional program so that you can, have greater cash flow, extend the lifetime amount of your nest egg. I mean, the benefits just go on and on and on. And, that's the thing, again, that a lot of people don't talk about with the reverse mortgage. You can treat this just like any other loan. Let's say you have a $300,000 loan balance and you're paying, I don't know, $2,500 principal and interest for that each month, and you convert it into a payment optional reverse mortgage. So you no longer have to make that $2,500 if you don't want to. Now with a reverse mortgage, you're still going to have a monthly payment, but it's not going to be required that you make that. So basically, you can put yourself in a position where you don't have to make that monthly mortgage payment again. But guess what? If you want to make that payment, you can. You can treat this, you can pay it off, you can pay it off early. You can treat this just like a regular loan. So, the other thing that people talk about with this program is negatively amortizing. You're going to go, the loan balance is going to grow. Yes, it does if you choose not to make that monthly payment, and it gives you the choice to do that. So really the peace of mind and the freedom to do that is really where this program really shines. Because if you go upside down or you or have a negative amortization on a reverse mortgage, it's really by choice because you still can make a monthly payment. So let's get into the program here and to the presentation. Once again, my name is Zach Smith. I'll be your host today. I've been in the mortgage industry. I was thinking about this the other day. This is the only thing I've ever done since I graduated college in 2003. I had all kinds of jobs in college, as a college kid, I was DJing at nightclubs. I was, delivering appliances, working in freezer warehouses, you name it. I was doing anything. But after I graduated college and I got a career, I went right into mortgage. I haven't done anything else. So this is where I'm at. This is what I do. So I've been voted as a 5-star professional for, since 2018. I'm very proud of that. I also have the certified senior advisor designation, which again, that's a pretty hard designation to get. And it took me a lot of time to get that. And I'm glad that I took the time to do that just because the knowledge is just really helps me understand my clients a little bit better. And then, I'm a wholesale mortgage broker. I'm not really a one-man marching band. I can't really make claim to that because we do have four other loan officers that work with us, and we have a small processing team as well. But I'm a tiny little potato. I used to work for a lot of the big banks, Chase Bank and Fairway Mortgage and Cherry Creek Mortgage. Well, Cherry Creek's not around anymore. They got gobbled up during this downturn in the market. But I used to work for a lot of big banks, and I love being able to work for myself because some of the things that happen at big banks is that, or big institutions is that they could say, okay, this is what you got to sell, go sell it. So you have a certain amount of programs that's it. And if people don't fit inside that box, well, they can't do the loan for you. Well, as a broker, if we have outside of the box situations, we can really dig deep into our contact of lenders to find somebody that can get something done that may not be the easiest thing to get done. But the biggest advantage I think that my business has, and also my clients have by working with me, is that we are a broker, and I am a small shop, so I don't have a really large overhead. You know, when things were doing really well and business was falling out of the sky in 2020, I didn't go out and buy a Lamborghini or go get a big office or anything. So I've stayed pretty humble, and boy, am I glad that I did, because keeping a small overhead really helps me create savings for my clients, because we don't have to make a whole lot on these mortgages to make it work for us. So usually our pricing is much better than what you'll see at like a major bank or something like that. Who qualifies for a reverse mortgage? Well, you got to be 62 or better for the FHA program, 55 in some cases. There are programs out there that will offer 55 and up. It does have to be your primary residence, so you got to be there at least 6 months in a day. FHA or conventional programs, best terms, the FHA version. Now, it's not really a conventional. It should be a proprietary is what that should say. So for instance, if you have a condo that's in an FHA complex that's not approved FHA, or I should say not approved FHA complex, well, you can't get a reverse mortgage there. So what we do is we look at some of these proprietary programs to get around that. So you do need equity or a large down payment. That's really the biggest barrier that I think most people see with this type of situation, is that you do need a lot of equity, and that's become more common these days. You know, there's a big misconception out there that if you do a reverse mortgage, you don't have title to the house anymore, or you're going to go upside down on your property. That is not the case at all. You know, many of these banks are hedging the risks so you don't go upside down, because guess what? If you go upside down on your property with a reverse mortgage, guess who loses? The bank. The bank loses, because then they hedge their bets, and then they end up at the end. Let's say you live in your property 30 years, you're 100 years old, and you lived a long life. If you pass or give the property away, let's say you're upside down at that point. Well, then the bank is stuck with a property that they got to try to sell and take a loss on. So it's not something that the bank wants. They don't want you to go upside down. That's a losing proposition for the bank. Banks don't like to lose money. We lend them we deposit $10 and they lend 9 of it out. They need us. And that's how the banking system works, is that they make money off of our money, off of our interest. They've become quite good at it too, especially if you look at what everybody calls the safe mortgage, the mortgage that everybody gets, and what other products are there out there. We're kind of painted into a corner here as consumers. 30-year fixed loan. That's what most people get. You go to your financial advisor. Of course, everybody's going to want you to do a 15-year. I mean, it makes more sense. You pay less interest. Personally, I'm not a big fan, because you can still pay a 30-year loan off in 15 years. You're just not forced to. But I digress. In a 30-year loan, you pay 50% of the interest in the first 10 years. That means your first couple of years of payments, you're, for instance, someone who has a $600,000 loan amount paying 6 1/8%, their first payment is going to be about $3,600. Well, only about $600 of that is going to pay off the loan. $3,000 out of $3,600 of your first payment on a mortgage is going to the bank in interest. And, I just think it's the craziest thing ever that people look at that and think that that's a good deal. It's not a good deal. So I always recommend folks that we do a forward mortgage with, put a little towards principal, put a little more. You're going to shave off time on your term, and you're going to start, really getting into paying off that principal as well. I always will offer the reverse mortgage product as opposed, side by side, if I have clients that will qualify for both. And most of the time they do choose the reverse mortgage, simply for the fact that if you are over 62 and you're looking at a 30-year fixed or whatever the case is, and you find out, okay, my hard-earned retirement, my nest egg, is going to go right to the bank. Most of my payment is going to go right to the bank. I worked my whole life so that I could make the bank richer. I don't know that would sit well with me, and it doesn't sit well with a lot of my clients either. So a lot of times people will use the reverse mortgage and say, well, heck, instead of making this taking my money and paying the bank interest, well, why don't I just take that money I'd rather be that I would normally be making my monthly payment with? Why don't I just put that in my pocket? Well, what does that do? Well, now it gives you choice. Now you can direct those funds. You can say, okay, well, I'm going to, instead of making a $2,500 payment towards my mortgage, well, maybe I'll make that towards an investment. Maybe I'll open up insurance policies on my grandkids, because the rates are so low and the growth is the same as an adult. There's all kinds of different ways, but you have the choice now. You're in the driver's seat. When you're locked into making that monthly payment each month, they come knocking if you're 30 days late. And if you're 90 days late, well, they can take your house. So it's one of those things where people really like the peace of mind of having that reverse mortgage. And really, in my opinion, it's the smarter thing to do. Yes, you are accruing interest on the loan. Yes, it's accruing interest, but your home is also appreciating in value as well. Not as much as it was. We are definitely not seeing the appreciation that we were seeing 3 or 4 years ago. But if you take real estate over a span of time, just like the stock market, you're going to see that there are ebbs and flows. But for the most part, you usually are getting a much better investment, not to mention the tax write-offs and stuff like that. So anyways, there are minimal qualifications for the reverse mortgage residual income calculation. Basically, we just need to see that you can pay your monthly payments, or I'm sorry, your monthly obligations that show up on your credit report, along with utilities, maintenance of the property, HOA, taxes, and insurance. So it's much, much easier to qualify for a reverse mortgage than it is a forward mortgage, because the risk assessment is completely different. The risk assessment on a forward mortgage is, well, you want to borrow $300,000? Well, that's awesome. Great. Well, how are you going to pay us back? What kind of a borrower are you? They won't, and they'll start looking at your debt, your income, your debt to income ratio, and all that to determine how big of a risk you are of if they lend you that $300,000, are they going to get it back? With a reverse mortgage, there's no required monthly payment. So the risk assessment is completely different, which does make it much easier for people to qualify. The only caveat is, though, is that there's age restrictions. So reverse mortgage information continued. Now, most of these programs are FHA programs. So, one of the knocks on the reverse mortgage, again, is they're costly. Up front, you're going to pay a 2% upfront mortgage insurance premium. I'm telling you, the good, the bad, and the ugly, but this is just the facts. People do not like that. They look at it, you got a $600,000 home, you're going to pay 12 grand at closing. And people look at that and say, oh, the reverse mortgage is a bad idea. Well, that's not a reverse mortgage thing. That has nothing to do with the fact that it's a reverse mortgage. It has everything to do with the fact that it's an FHA. For example, people that get FHA loans, and it's been very common these days in a high interest rate environment, first-time home buyers, FHA is a great option for people because they have more lax guidelines. We can get people approved for more house by doing an FHA, and their interest rates are usually lower, actually in some cases much lower than a conventional loan. So it's been pretty popular these days. Well, guess what? People are paying that upfront mortgage insurance premium, first-time home buyers, people doing just a regular FHA loan. So it's not that reverse mortgages are expensive. FHAs are expensive. I mean, we're talking about the Department of Housing and Urban Development. It is a government loan. It's good and bad. Best thing that happened to these programs is the government got involved. Worst thing that happened to these programs is the government got involved. So, it's a double edge, you take the good with the bad. But in my opinion, I think the benefits of having government involvement far outweigh the detriment of any reverse mortgage situation. So, the amount of money available in a reverse mortgage is determined by the age of the youngest homeowner. So these are basically like an actuary table that they look at for the reverse mortgage. So for instance, someone who is 62 can borrow less than someone who is 92. So benefits of a reverse mortgage continued. You do get to keep title to your home. I am so tired of hearing people say, oh, they're going to take your house. The bank owns your house. What? That was never a thing. That was never a thing. Now, some of the past reverse mortgages, I would say prior to a decade ago, the bank actually didn't do a very good job on those, because some people did go upside down with those. And there was also an issue with non-borrowing spouses, people who were 62. So if you had a husband who was 62, a wife who was 58, well, at that time, 10, 15, 20 years ago, only the person who's 62 would qualify. So what happens if something happens to the husband? Well, then the wife is in the property and she's not on the loan. So it was a really bad situation. They've cleared all of that up. They don't have those type of guidelines anymore, for good reason. So basic credit income qualifications, again, tax-free cash from equities. So if you take cash out from a reverse mortgage, it's not considered taxed, nor is it considered income. It's all considered a loan. So if you're looking to qualify for Medicaid, things like that, it should not be counted against your qualifications. Monthly payments, again, are optional. If you want to make a monthly payment on a reverse mortgage, go for it. 99.9% of people don't make that monthly payment because it goes against the principle of it. But no pun intended. Again, you can make a payment if you want, but the payments are optional. The two biggest myths that I see is, one, you lose title to your home. That is just the silliest thing I've ever heard. No, you don't lose title to your home with a reverse mortgage. Again, you don't lose title to your home. You have a lien on the property. So do you really own it if you have a lien? Well, if that's the case, then everybody who has a mortgage doesn't own their property. The bank technically owns it until you pay that lien off. So, but that you do have a lien, but you own title. Your name is on title. And that you're going to go upside down on the property after you take one out. And that the kids are going to be left with nothing. That's something that people are concerned about. One thing I would recommend is, if that's something you're concerned about, go to your local reverse mortgage provider and have them put together an estimate. Because in every estimate, at least the ones that I send out, I can't tell you about my competition, but I can tell you one thing about my competition. They are the best advocates for my business. You'd be surprised at how many people go to somebody else and then they talk to me, or they talk to us here at Chariot, and they find out, wow, you guys really do things differently here. So, go to your reverse mortgage guy, whoever you're working with, or gal, and have them put together a amortization schedule for you, because that's really going to be helpful to understand, okay, if I get in this thing, if I pull the trigger and do this, what's it going to look like in 5 years? What's it going to look like in 10 years? So that way, and a lot of times this is, in my opinion, I think the whole family should be involved. I always encourage people, get the whole family involved. Come to the table and see what's going to be best, because a lot of people are concerned about what they're going to be leaving to their kids, when in reality, they should be concerned about how much they're going to cost their kids. The cost of care is through the roof. A lot of people are concerned about leaving stuff to the kids until they get into a situation where they need long-term care. When they start needing long-term care, the conversation shifts completely. I had a gal, a couple of years ago that, she called us. It was for her dad, because her dad was making, I think like $1,800 in Social Security, and his payment was $1,500 a month. So she's having to supplement her income every month just so her dad can scrape by. He's cracking that nut every single month so that he can make that mortgage payment and essentially just pay the bank interest, is really what we're talking about. So what we did was we converted that $1,500 payment into a payment optional program. And I think he's paying like $1,200 principal and interest. So now, instead of having a $1,500 payment, he has like a $300 payment, just as taxes and insurance. Well, now she doesn't have to supplement her income any longer. Her dad gets to stay in the residence. And that's the thing that a lot of people, I think, need to really have some foresight about. Right now, everything may be going well. They say that in retirement age, you have 3 stages. You have the go. I just retired. I'm just, I'm going out, I'm having fun, I'm traveling. Then you have the slow go, where it's like, okay, I'm starting to slow down a little bit. And then the last stage is the no-go, where you need to really make sure that the house is fitted and things like that. But if you decide to go into 24-hour care, or you need 24-hour care, Well, it's a really tough position to be in because you're talking anywhere from $8,000 to $12,000 a month for those facilities. A lot of people talk about, some of the closing costs that incur with the reverse mortgage. Well, that pales in comparison to having 24-hour care in a facility. It pales in comparison. So being able to put yourself in a position where you can not only reduce your housing costs, because that's what basically the biggest cost that everybody has, myself included. If you can eliminate that in retirement, well, guess what? Your nest egg is going to last a lot longer, and that's liquid. So it's hard to talk about this program without talking about retirement in America. As you know, I'm not going to go over a lot of these stats, but basically this is telling you that people aren't saving. People aren't saving nearly enough, and the people that aren't saving enough. So in our culture, we used to have pension plans and things like that. They gutted those in the 70s and said, "Hey, those are gone. We're going to give you this 401k. Good luck. You're gonna do just fine." Well, Americans haven't done just fine. So the people that are saving are just not saving enough. So we do have a retirement issue. And that's one of the biggest things that people worry about is running out of cash prematurely in cash flow. So let's talk about cash flow a little bit. That's the number one issue in retirement is cash flow. Cash flow issues in retirement arise due to fixed incomes, inflation, unexpected expenses, potentially outpacing available savings and investments. So these are the three buckets of finance. Generally, pre-retirement, we have income. We're saving in our 401k. We're taking our income, saving our 401k. And then we're also paying down our house in equity. And this is another reason why it's my assertion that, post-retirement, these buckets change quite a bit. So one, as you can see, your cash flow decreases. So this red bucket, your income bucket, decreases quite a bit because now you're on a fixed income, or you may not have a pension plan. If you have a pension plan, retirement, all that stuff, you're on a gravy train with biscuit wheels. This is a program that's going to be used more for a financial planning purpose, not so much a program of necessity. It can be used either way. People think it's just a program of last resort, but it's not. People who have, millions in the bank are doing these as a safety net so that they can open up that line of credit instead of going into their assets. A lot of tax advantages by doing that. This second bucket becomes very important because this is your crown jewel. This is your savings. Now, savings becomes important because we don't know how long we're going to need it, nor do we know how much we're going to need, because we don't know how long we're going to be around. You could live to 70, you could live to 80, you could live to 90, you could live to 100. But the difference between 70 and 100 is 30 years. So to be able to be solvent for your savings for 30 years, it's like the old Boy Scout motto, be prepared. You don't know. You don't know how long you're going to live. You don't know what kind of health things will come up. You just don't know. So to have liquid savings is vitally important. And I stress the description liquid, because equity is great to have, but it's a lot like having that glass coffee table right there in the middle of your living room full of cash that you can't get to. So, having equity is great, but if the car breaks down or something medically happens or, something happens, well, you'll need to get into that savings, into that equity, into that coffee table with all the cash in, and you won't be able to do it. That's why a lot of people open up these lines of credit ahead of time as a safety net. And again, post-retirement, most of your income is going to be in your equity, either through appreciation or through buying or paying off debt over all those years. So in my opinion, it doesn't make any sense for someone to make a mortgage payment after the age of 62. And I'll tell you why. Because if you are making a mortgage payment after 62, you're taking it from one of two buckets. And I'm here to tell you right now, it's not the buckets you want to take from in retirement. Number one, you're either taking it from your cash flow. So you're taking this little tiny bucket, and you're just like the example I gave, He's trying to determine, okay, what do I pay this month? The gas bill or the electric bill? Is it going to be warm out? Do I need AC? People shouldn't be making these decisions. Oh, can I get groceries this month? I mean, I know that sounds destitute, but as we have this conversation right now, or as I make this video in real time, someone is feeling that crunch. And you probably know somebody who's feeling that crunch. So by making a mortgage payment, you're basically taking from this bucket, which you may not have, it may not be as large as it used to, or you're taking it from this one, your most important bucket, which is your nest egg. So to me, it doesn't make any sense to make a mortgage payment if you're 62 or over because of which buckets you're taking from. A lot of times people own their homes free and clear, or they've paid them down to the amount where they can start using that equity to their advantage. Converting it, that's what the reverse mortgage does. It just opens up a little drawer in that coffee table with all the cash so you can pull some cash out when you need it. If you don't need it, then, you don't take it out. So again, stop making a mortgage payment. If you're over 55 or you qualify for a reverse mortgage, you don't need to make that mortgage payment any longer because it doesn't make any sense. You're either going to be taking it from your cash flow or you're going to be taking it from your savings. Even if you if you don't have a whole lot of time on the mortgage, whatever, I mean, you want to pay it off, great, no problem. And then people, you want to leave it to the kids. Again, the question you should be asking is what long-term care insurance do you have in place? What is the plan for that? It's not how much you're going to leave to the kids. It's what am I going to cost to my kids? So that is a shift. Now, if we lived in, and I'm not going to get political, that's dangerous, these days. We're so divided. But we don't live in a country where we're taking care of people. I mean, we got Medicare and things like that. But, medical debt is still the number one reason why people file for bankruptcy. So again, pre-retirement buckets, you have your income, you're paying, you're saving, and you got your home equity. It's just kind of sitting there. Post-retirement, things change quite a bit. This one gets smaller. This one becomes more important. And this one's just sitting there empty, ready to, full of gold coins that you can basically utilize. Okay, so again, there's a lot of home equity out there right now. We had some great growth during COVID and during 2020, so there's a lot of equity out there. But what is equity? Let's talk about it a little bit. It's cash. It's accessible unless you sell or take out a loan and pay it back with interest. Again, it's like having that glass coffee table right there in the middle of your living room full of cash that you can't get to. Does it really benefit you in retirement? Can you go down to the grocery store with a picture of your house and pay for your groceries? It doesn't work that way. Is it better to pass on a higher net worth or more equity? Now, that's a good question to ask folks who are looking at, I want to save cash for my kids. I want my kids to have the home. I own it free and clear, even though I'm scraping by, eating bologna sandwiches every day, just making it. I want to leave it to the kids. Well, what if you were to take a situation where you can invest some of that equity early, or do you want to see the kids enjoy it while you're still here? That's another reason people will look into these. So what do people usually do when a home is bequeathed? They don't normally hold on to the home. They usually sell it. 9 out of 10 times they'll sell it. So they want the cash. They don't want the house. Does cash do better in your pocket or locking it up in the home? This is a conversation that I have when I hear people, we're going to pay cash. And right now, a lot of people are paying cash for real estate because it's costly for money right now. Interest rates are on the high side, so people are paying cash for properties. My opinion, depends on your situation, I guess, these days, because rates are pretty high. But in my opinion, I wouldn't pay cash for a property ever. And the reason is that once you put that cash into the property, you lose all control over it. You put it in the hands of someone else. I want my money in my pocket. I want my money in the bank account so I can direct it, so I can get to it, so I can be liquid, so I can make other investments and things like that. You put money into a property, well, you can't do that anymore, because if you want to get it back out, you got to either call up a buyer and sell it. Then that begs the question, where do you go? Or you got to call up a bank and pull out a loan. So I think it's better just to get it all done at once. Purchase as a reverse mortgage product, and then you can put yourself in a position where you have more cash in your pocket and never have to make a required monthly mortgage payment the rest of your life. Well, it's been great hanging out with you all for a half hour here. I hope you enjoyed. I hope you got something out of it. And if you ever have any questions for me, or you just want to learn a little bit more about the program or have a personal consultation, don't hesitate to reach out to me at chariotreverse.com. Once again, that's chariotreverse.com, chariotreverse.com. Thank you so much. I hope you have a blessed rest of your day. May blessings rain down on you and your family like that of 1,000 suns. Thank you so much. We'll talk to you soon.